Sure. We've got two other guests joining us on the show. We've got Mr. V. Ashok, the Group CFO of Essar Group, who's joining us, as well as Rashesh Shah. He's the Chairman and CEO of Edelweiss Capital, who's going to join us right now to discuss this in further detail. Rashesh, first to you. Obviously, you've seen, and it's pretty much in line with what the street has been expecting, 25 basis points. What's the stance going forward in terms from a market standpoint as well?
I think the good thing RBI has been doing is, this slow creeping kind of hikes in rates so that the system does not go into a shock. Though I think there was a part of the market that was also ready for maybe 50 basis points. I think 25 basis point is good. It's, I think, gradual. Though I think the way inflation is and if your GDP expectation is still 8.5, I think the street feels that RBI has room for another couple of hikes if inflation continues to stay hard as it is now.
Surely the street is pricing in that. In fact, just before we go to the guests, pull up the bank nifty and pull up the key banking stocks, because out of the 8 or 9 components, almost all of them are now in the green. So that's priced in. In fact, just losing sheen now because the market factoring in the initial trading gains and then cooling off. So pretty much in line with estimates, and that's what probably the bank nifty is showing, though most of the components are right now in the green. Ashok, thanks for joining in. Neeraj, how would you take this? I mean, it's a 25 basis point hike, yes, but there has been a serious note of inflation, serious words spoken on inflation, 7% upward bias on inflation. You think with the rise in interest rates, if not calibrated, would hamper credit growth, which has not happened till now?
No, I think the worrying part is the inflation going up to 7%. So I think the concern from our side, from a group's perspective, is we have seen this for the last 6 months, an upward bias in interest rate movements. That's a huge cause for concern. Project cost will go up, the cost of borrowings will go up. I think that's a cause of concern from the industry's perspective. And I don't see the end of the road for it right now. I still feel the couple of hikes still remain to be implemented over the next 2 to 6 months. So I think it's a worrying time for us from the corporate perspective, but then we have to see how it goes on from here.
Okay, if I may ask you, what is your current rate of borrowing, and how much of a dampener would this be in terms of your funding requirements going forward, and how big a constraint is this for you?
We are borrowing at very competitive terms. That is not actually a concern. The only thing is the banks also have no alternative other than to pass on to the borrowers. So that becomes a dampener as far as we are concerned. Going forward, fortunately for Essar, we have all our projects totally tied up for all our requirements. So we don't have issue of liquidity. But this setback every 2 to 3 months, there is a possibility when banks may pass it on to us. That's where cost of project will go up and cost of borrowing will go up, which will impact profitability, which is the case for largely people like us who are in the infrastructure business. It hurts us more.
Rashesh, what does this do to the markets now? I mean, if market is taking it well, status quo before and after the policy, but that is predominantly because the policy exactly in line with estimates. What happens ahead? Earnings season pretty much coming to an end. Key earnings haven't disappointed, credit policy in line. What does the market look forward to?
I think all the estimates of GDP growth, the estimates of inflation, I think all that was in the price. Even the 25 basis point price was already in the price. So I think overall the market is currently just heaving a sigh of relief, and even the results that we have seen from the banks and everybody else have not been very bad. So I think the market is saying, okay, I think headwinds are still there. Interest rate hikes, inflation, liquidity squeeze are still problems. I think going forward, investments may slow down if this continues for another 3 to 6 months. But currently, I think it's more heaving a sigh of relief and saying, okay, things are not getting worse, though they are not great as of now. They are not getting worse. And I think everything from the GDP growth rate to the inflation estimates is what I think all of us were expecting in the market.
Rashesh, I want to boil it down to one space at this point of time, and that is the BankX. The last 4 days, the banks have, in your terms, heaved a sigh of relief and given decent returns, 5-6%. The problem would be that most of the market participants are pricing in NIM compression in Q4, possibly Q1 next year. If the RBI stance on inflation and the belief that there will be subsequent rate hikes, if anything, just increases the negative sentiment further on compression in margins. How would you play banks now going ahead for the next couple of quarters?
Q4 will still not be great for banks because I think all of us, even all the banks, believe that the rate hikes are not over. There are a couple of more hikes on the anvil. So I think the rate hike situation is not over. I think the liquidity situation is still fairly severe. I think the short-term liquidity squeeze is still continuing. So Q4 is not going to be a great quarter for the banks, but the banking sector is very healthy, very strong, as we saw in the Q3 results. The bank have enough opportunities to ensure that they can pass on some of the cost. I think NPA quality is still not getting bad, which is good news also for the banking sector. So overall, it won't be a great quarter for the bank, but I think given the robustness of the banking sector, it won't be a huge area of concern. But I think another couple of rate hikes is there in the price. The banking sector has fallen a lot, more than 20% in the last couple of months. So what we saw in the last 3-4 days is more like a relief rally. But I think for the next 5-6 months, most analysts expect the banking sector to be sideways, because even that won't be bad, because they would have absorbed these huge series of hikes over the last year and still come out stronger. So on the whole, it's good, but I think short-term headwinds continue.
Shubhra, I would like to come to you on one bit that Ashok also spoke about, which is the investment cycle that can come under some bit of pressure. While you will have continuous working capital lending going on, that's not a concern, but investment cycle lending, investment lending is something that can take a little bit of a backseat with the calibrated liquidity tightening measures that the RBI is taking. How big is the concern for the overall growth then if the investment cycle starts to slump?
Well, I think if you look at the components of the growth, it's essentially currently consumption, which is driving predominantly the growth impetus. But yes, sizable traction in the investment trajectory has also supported growth adequately, and it is important that we see this trajectory improve as the quarters come in. There is a risk, no doubt about it, in a rising interest rate scenario that the pace of the investment cycle recovery would get compromised to an extent. But my sense is investment would be more susceptible to the policy environment supporting the investment demand rather than just interest rate costs. I think the stakeholders are more looking for a stable policy framework and a forward-looking and a direction-giving policy framework so that investment gets attracted to the economy, both from private players as well as global investors through FDI route. So interest rates definitely will have a role to play in deciding the pace of investment cycle, but there are larger issues which essentially would drive the environment for capacity creations. That's my view at least.
All right, Shraddha, leave it at that. Thanks so much for joining us today and giving us your perspective. One word really on what does this do, the policy or the expectations do to the currency movement?
Well, I guess the policy highlights one of the issues that we're all grappling with, which is the current account deficit. 3.5% of GDP is clearly a scary kind of number. The last year we had very robust capital flows to sort of equalize this current account problem. Going forward, we might actually see both these numbers coming down. Current account deficit is showing signs of improving. At the same time, there are question marks on whether the pace of capital flows will continue. This year around, actually the G3 markets are doing well, Dow is doing well, so you actually might see money moving towards those markets. Plus other EM currencies and other EM markets are also going into rate hike mode, which might attract a decent amount of capital. So I think there are questions about whether capital flows will continue along the lines of last year. Last year was clearly an FII bonanza with $29 billion coming in. So I think a lot of iffiness on the FX market. We could see the market going in a range, while the market consensus is for rupee strengthening down to 43, 43.5. I wouldn't be surprised if we actually see 46.5 in the interim, given the precarious nature of this balance.
Right.
All right, we'll leave it at that. Thanks very much for joining us, Anant, in this discussion. Let's go across straight to Dr. Pranab Sen, the Member of Planning Commission, for more on the RBI's recently announced credit policy. Dr. Sen, thanks very much for joining in. 25 basis points hike, that's the kind of step that RBI has taken. But then again, a big concern being the upping of the target for inflation for the year, which has come at 7%. Is that a big worry?
No, I mean that is just a recognition of reality. We had originally expected inflation to sort of steadily come down, and with this 1 month blip that has taken place in the middle, it's sort of disturbed the trend, as it were.
Right. So, Dr. Sen, what happens here? I mean, you're looking at the RBI's comments, they have clearly mentioned that inflation would be high and inflation containment would be a top priority. You would believe it's a given that there would be a series of rate hikes going ahead, even if it were to hamper growth?
Well, the rate hikes are only one of the options. The fact is that I think the inflationary concerns now have to be taken seriously. It is quite evident that non-food inflation is also becoming quite serious, with a fair amount of wage component that's driving some of that. Going forward, we do not really know, because we do expect that a lot of the investments that are taking place during the course of the year would be coming into production quite soon, and that will reduce the pricing power of the companies, and therefore one could expect to see a certain degree of moderation in inflation even without a rate hike.
Sen, do you believe that if the supply side constraints and the structural issues regarding inflation are not kept under check, interest rate hikes could at all do anything that could bring down inflation?
Yes, it can, but what it really does is it redistributes the pain from the structural deficiencies. The problem with inflation is that it essentially redistributes scarce commodities away from the poorer to the richer. And what contractionary monetary policy does is basically it reduces that tendency.
Right. But Dr. Sen, based on, I just heard you speaking about how interest or inflation is likely to come down going ahead. The RBI has clearly stated that 7% is the order of the day. For how long do you think RBI will continue with this rate hike cycle? Because that is something that is under their preview. Containing supply side is probably not a very quick term or an easy solution to have. How long or how many rate hikes further you believe are the order of the day?
Well, the fact that RBI has gone in for only a 25 basis points rate hike seems to suggest that, they are still not convinced that this is a sort of an investment-led demand boom. And I subscribe to that view as well. We have no indication that fresh investment intentions are running way ahead of the curve.
Dr. Sen, what does this do to the fund flow situation right now? Keeping in mind that FIIs have been pumping in money and the kind of ease of liquidity that US has, most of the money could see a direction towards India. What does it do for the fund flow situation?
Well, I think that danger has receded a bit. The markets around the world seem to be getting stronger, which means that there is a much higher scope for diversification of investments by the portfolio investors. So I don't think that in itself is a huge danger at present. So I wouldn't worry too much about it if I were you.
Ashok, just commenting on what Mr. Sen had to say, what happens to growth or credit growth going ahead if indeed the rate tightening cycle continues? You believe there would be a case wherein the RBI would review its stance if indeed credit growth gets hampered as a result of maybe this rate hike or a couple of subsequent rate hikes?
Yeah, I think it would. Right now the credit growth has been fairly stable. Short-term liquidity is a concern. Long-term is not. There is an appetite for funding a big project, so that's not a concern right now. But as these interest rates keep growing, showing an upward trend, I think there will be a time when RBI needs to review its stand. And I personally see a slackening of demand for credit from the second half of the year if this trend continues. That's our reading and my reading.
Dr. Sen, coming back to you, the current account deficit stable at about 3.5%. Big worry there?
Well, is a worry. You know, we are a little sensitive to any current account deficit in excess of 3%. But this is episodic. It's in a situation which is very unusual. So it isn't quite time to press panic buttons as yet. But if it continues, and my reading is that it won't continue for very long, you'll see it coming down steadily. But if it does continue, we would have to look at it very, very carefully.
All right, Dr. Sen, just before we let you go, I'm asking this question to you again. You believe another couple of rate hikes are the order of the day?
Not immediately, no, I don't believe so.
But over the next 3 months, you believe a couple of rate hikes would happen?
No.
All right, Dr. Sen. Thanks so much for taking the time out today and joining us and giving us your perspective. That's Dr. Pranab Sen. But let's get across to one more voice. Mr. Srinivasan Varadarajan, the Executive Director of Axis Bank, joins us for his views on the policy. Thanks so much, Mr. Varadarajan, for joining in. It's pretty much in line with what everybody was estimating. Two questions. One, would the rate hikes today have any impact on the lending rates? And two, the deposit rates haven't really grown. How do banks expect to garner further deposits in light of what the RBI has just recently announced?
I think, as you said, the increase in repo rates by 25 basis points is in line with market expectations, and I think that's the prudent thing to do, because I think the current money market rates, especially rates at which CDs and CPs are prevailing are pointing to much higher policy rates. So no reason for policy rates to be hiked in a hurry, because anyway money markets are very tight and liquidity is tight. So in terms of cost of funds, it's already tight. To that extent, I think base rates and DPLs have increased. One needs to take a close look over the next couple of weeks to see whether cost of funds stay here or edge up higher as we go close towards the end of the fiscal year, and then take a call on lending rates. But prima facie, as of today, I think it's still wait and watch mode in terms of any increase in lending rates is concerned. As far as cost of funds and deposit rates, I think the last quarter is usually a busy quarter, and clearly there would be rush for deposits, and clearly deposit mobilization has to increase as far as banks are concerned because of credit growth being higher than what was initially anticipated. So one would have to wait and watch, but I think deposit rates can show a mild uptrend.
Mr. Varadarajan, now we've got a whole slew of banks that have come out with results, and they've actually guided for an upward revision in terms of the loan growth for FY11. FY11 is not a concern anymore, but keeping in mind the tightening liquidity situation and with the RBI taking these calibrated measures to put liquidity under curb, FY12 loan growth, do you see that becoming a problem?
See, I think one has to appreciate bank loan growth vis-a-vis the prevailing money market conditions. Whenever liquidity is tight, credit growth or lending from banking sources increase. Lending of non-bank sources tend to decrease in tight liquidity scenarios, and that's what we're seeing this year, where funding has moved from non-bank sources to banking sources, and therefore credit growth for banks has been higher than for what was initially anticipated. As we go into next year, if liquidity comes back and money markets are a lot more easier, I would think credit growth around 20% is something what we should shoot for even next year.
Would you want to hear anything specific from the RBI with regards to liquidity measures, Mr. Vadaraj?
I think they've announced whatever liquidity measures for this quarter in terms of extension of the facilities which are currently in place for the rest of the quarter. So I think considering the anti-inflationary stance which they've elucidated in the policy, I think further liquidity easing measures would be too optimistic to expect.
Ashok, bankers are fairly upbeat about credit growth remaining stable. You as a corporate would believe so as well, never mind the fact that there could be maybe a couple of rate hikes. Dr. Sen went on to say that in the next 3 months he doesn't see 2 rate hikes. What happens to credit growth then?
No, I said the credit growth is not a concern in the medium term. I still the whole there is a lot of demand for good projects. We are seeing banks willing to finance the long-term projects. I only mentioned that short-term liquidity is a bit of a concern. That's what I mentioned. But I think we'll all have to wait and watch as things unfold over the next 6 months to 12 months. A lot of things have to change. I think a lot of worrying factors as per the policy today. So we'll take a look and see how it goes along.
All right, we've got George who's also joining us right now. George, any more details coming up?
I don't have details, but I have a question for Srinivas Varadarajan. Srinivas, the fact that the RBI has flagged off the issue of credit growth running at 24%, deposit growth lagging significantly behind, despite the fact that banks have raised deposit rates by as much as 250 to 300 basis points, what do you believe the big issue really there is? Would you say that the average person is choosing to spend his money more simply because his money doesn't give him a significant return by way of putting it in a deposit, or would you say that a large part of that money is actually going into alternate assets?
I think the big problem this year, the big issue this year to contend this year is the increase in currency in circulation. Currency in circulation with the public has continued to stay high and has stayed high through the year and has not been as seasonal as one would expect. So I think that has been a dampener in terms of overall deposit growth. So even though M3 growth is say at 17.5%, deposit growth has been lower than 15%. So currency in circulation is something which has been an issue this year. I think in terms of customer behavior and consumer behavior, I think that's in line with what one would expect in terms of the overall demographic profile which we have right now.
Mr. Varadarajan.
Right, so Srinivas, the other point that the RBI really made was the issue of the credit deposit ratio running at a significantly high level at over 100%. One of the steps that it wants to take to address this, that the fact that credit growth is running significantly higher than its own forecast of 20%, is that it is going to engage with banks that have a significantly high credit deposit ratio and get them to bring that down. Now, how do you expect the RBI can actually achieve something like that?
I think it can only achieve it by slowing down credit and increasing deposits for the banks which have such a profile. So deposits have the focus on deposits, and deposit growth has to clearly improve as far as those banks are concerned.
Sure, but on the one hand, you've got a huge amount of demand for credit coming from the corporate sector, at the retail level, infrastructure, from everywhere. On the other hand, despite interest rates and deposits having been raised fairly significantly enough, you're still not seeing deposits go there. So how exactly is the RBI going to come and tell banks to tone their credit deposit ratio down? Are they going to come and tell banks you've got to stop lending?
I don't think so that happens. The issue here is, I think the situation we are faced is very tight liquidity and higher than expected demand for credit, and therefore that's the situation we are in, and that's a situation which is difficult to handle unless liquidity comes with deposit growth is not going to spike up to levels which possibly will support this credit growth. So we are in this situation where deposit growth is going to be slower than credit growth, primarily because demand situation is on the ground works that way, and it only means that if the banks have to raise lending rates to slow down credit growth, that's something we have to do depending on what situation each bank finds themselves in terms of liquidity.
Yes. Shubda, if I could come to you, the fact that the RBI has actually spoken about the need for the government to step in and increase the supply of food products on which there is a shortage and which prices have shot up significantly, to name just a few: milk, eggs. All right, okay, I think Shubda is not there now. But, Srinivas, just coming back to you, the fact that the RBI has spoken about the need for the government to step in and address a large part of inflationary pressures, how soon do you expect that can be achieved? Because some of the measures suggested are really long-term measures.
No, I think clearly it's a question of trying to say that monetary policy can only do as much, and expecting monetary policy to go much beyond and deliver on the inflation management side is something which the RBI clearly wants to communicate, that it is doing all of what it can, but the fiscal also needs to step in and try and sort these long-term issues.
Right, Ashok, if I could come to you, the fact that the RBI has said that what has so far been a food price inflation driven story, where food price inflation has held up for more than 2 years. They are beginning to see signs of that actually percolating down into generalized inflation, and that in turn having some sort of an impact on wage prices in the manufacturing sector. Is that something that you've begun witnessing at Essar?
No, not yet. I don't think that has really percolated to the group as of now. I think we're fairly okay. I mean, that is not really percolated in terms of abnormal increase in wages or any such thing. So I think we are okay with that right now.
Right, Ashok, but just quickly as a follow-on to that, while you said that you haven't yet seen that sort of play into your wages, wage prices as well as yet, do you expect that in the coming quarters, given the fact that inflation is holding up at the levels they are, you will actually see some sort of impact on wage prices? I'm sure it will. I think going forward, if this continues for next 6 months, I'm sure it will impact the need, or it will have. We'll have to relook at the need for this increase when we look at our compensation structures going forward. Absolutely. All right, Ashok, just very quickly before I let you go, are you somewhere saying that in the coming quarters you are coming to terms with the fact that you will have to work with narrower margins, given the fact that wage prices will go up in the future, and that already the fact that input costs are beginning to play upon your margins? No, I don't think this will really impact margins as such, George. I'm saying is that per se the numbers would go up, but as far as margins are concerned, there are a lot of other factors which are at play, so which will hold us in good stead in the coming year. The demand side of a lot of our commodities are looking up. The demand for steel, for example, is pretty good. The margins in refining business are pretty good. So I don't think that's a big number to worry about for us right now. So you are saying that pricing power will help you maintain your margins? All right, B. Ashok and Srinivas Vaidarajan, thanks very much for coming in on the show. With that, let me hand it back to Neeraj and Devi.